Welcome back to the channel, everybody. Today's video is all about terminology. So we're going to be talking about some important terms that you might hear when people talk about buying and selling stocks. And hopefully these definitions will help you to navigate the markets a little easier. So first up, we have going long and going short. These terms refer to how someone is betting on a stock's price. When you go long on a stock, it means you think the price will go up and you buy the stock. That's also known as bullish, which we've talked about in previous videos. On the other hand, when you go short, it means you think the price will go down and you borrow shares of the stock from someone else to sell it with the hope of buying it back at a lower price. Now, that would be considered bearish, which again, we've also talked about in a previous video. Next, we have buy to cover. This is a term that's used when someone has gone short on a stock and then wants to close their position. They do this by buying the same amount of stock they borrowed earlier so they can give it back to the person they borrowed it from. This is buy to cover. Another term you might hear a lot is pump and dump. This refers to a tactic where someone tries to artificially increase the price of a stock by spreading false or misleading information about it. Once the price of the stock goes up, they sell their shares for a profit, leaving other investors with a worthless stock. Now, that leads me to the next term, which is called bag holder. A bag holder is someone who is stuck with a stock that has lost its value and is unlikely to go up again. This can happen if someone buys a stock at a high price and then the price drops, leaving them with a bag, in quotations, of worthless stock. Halts is another term. Halts refers to when trading a stock is temporarily stopped. This can happen for a variety of reasons, such as if there's a big news announcement about the company and the price is going up very quickly, or if there's a sudden drop in the stock's price. Typically, halts last from anywhere from 5 minutes to 10 minutes, or sometimes they can halt overnight, depending on when the stock halts. Another term is low float. Low float is a term that describes how many shares of a stock are available for trading. If there are fewer shares available, it can make the price go up or down more quickly than if there were more shares available. Now, day traders love low float stocks because they can be extremely volatile, which means the price movements work for them as far as them being able to get in and out of a stock and make decent profit. All right, the next terms we're going to go over are ETB versus HTB. ETB versus HTB stands for easy to borrow and hard to borrow. These are terms that are used by brokers when they allow their customers to short a stock. If a stock is easy to borrow, it means that it's readily available to borrow, while hard to borrow means that it's more difficult to find shares to borrow. This leads to my next terminology, which is a short squeeze. A short squeeze, you may have heard, think of GameStop a few years back. A short squeeze is a situation where investors who have gone short on a stock start buying it back because they're afraid the price will keep going up. This can cause the price to rise even higher, and those who went short can end up losing a lot of money. All right, so I hope this helps with the next time someone is talking stock lingo to you. You will hopefully know exactly what they mean. Don't forget to like, share, and subscribe if you haven't already. And I will see you all in the next video.